Hello everyone. Today we will be learning about OTC and exchange-traded contracts.
A stock exchange is a centralized and regulated financial market in which equities, derivatives, commodities, and other financial instruments are bought and sold. Popular stock exchanges are the NYSE, Nasdaq, London Stock Exchange, Bombay Stock Exchange, etc. Though it is a physical location, majority of the transactions happen electronically with the help of an electronic communication network or ECNs that matches buyers and sellers looking to trade in securities. Let us understand the features of stock exchange. Well-established companies are able to raise money to finance their operations by selling its shares to the general public. The stock exchange is a platform through which investors are able to buy and sell such equity shares. Stockbrokers facilitate trading for their investor clients. The exchange is regulated by independent agencies, and thus the trading happens in a safe, transparent, and a systematic manner. For example, the Securities and Exchange Commission or SEC supervises and regulates the US security markets. Trading happens during specified timings and only standardized instruments are traded. The quality, quantity, and expiry date of contracts are predetermined. Here is an example taken from the CME Globex, which is a premier electronic trading system that allows trading of the broadest range of futures and options across all asset classes. These futures contracts traded on this platform will have the same characteristics and cannot be customized by the users. Customization is possible only in OTC markets. The prices are predetermined by the forces of demand and supply and are readily available for investors to buy or sell the securities. This formalized structure ensures transparency and liquidity of the trading system. Every exchange has a clearing house that validates and settles the transaction by ensuring that both buyers and sellers fulfill their contractual obligations. Through a concept called novation, the clearing house acts as a seller to every buy transaction and a buyer to every sell transaction. This eliminates the default or counterparty risk. As the clearing house is the counterparty for both sides of the transactions, the buyer and seller remain anonymous to each other. Both parties have to meet margin requirements in order to trade in derivative contracts. We will learn about the various types of margins when we learn about futures contract in the next video.
OTC or over-the-counter markets involve trading of financial securities outside formal exchanges with the help of brokers and dealers. Financial assets such as equities of unlisted companies, bonds, and various types of derivatives are commonly traded. This is a decentralized market, that is, unlike a stock exchange, this market does not have a physical location. Brokers facilitate the transaction between the counterparties for a commission. Dealers act as counterparties and trade with individuals, corporations, and other dealers. There is less anonymity as the buyers and sellers can know each other. Also, the prices at which these transactions happen may not be publicly disclosed. Such transactions are not supervised by financial market regulators. Dealers can also act as market makers, that is, they can act as the counterparty for the transaction. They provide bid and ask quotes and are able to provide liquidity in the market. Bid is the price at which the dealer is ready to buy, and ask is the price at which the dealer is ready to sell. If an investor wants to buy the security, he has to pay the ask price. If he sells the security, he will receive the bid price quoted by the dealer. The difference between the ask price and the bid price is called as the spread. It is the commission earned by the dealer. Participants in the OTC markets are exposed to various types of risks. Counterparty risk is the most significant. It is the possibility of the other party defaulting in its commitment before the contract expires, that is, failing to pay or failing to deliver the underlying. As prices are not disclosed and these markets are unregulated, there is a lack of transparency. Some instruments are relatively illiquid and the dealers charge a higher spread. Also, as the instruments traded are non-standardized, it is difficult to determine the fair value. Events such as the 2008 global financial crisis can affect the stability of these markets.